sort of more regional equity sectors to look at the specialist equity sectors. And what we've got here is a sector that did relatively well last year, as people got excited about all of the ways that we could fix COVID, and actually gave back an awful lot of that performance and more in some cases this year. So actually returns look a bit lackluster. The only real star here is the one BB Healthcare that doesn't have much exposure to biotech. So it's invested in all of the sort of things that facilitate healthcare, the hospitals and the diagnostics and dentistry and all that sort of stuff. And there's a question here about, why not PCGH? I'm not quite sure why I've missed Highly Capital Global Healthcare off that table, but I would have thought that it would stop in there between BB Healthcare and Worldwide Healthcare. I'd have to go and check, but I think that's where it would come. Andrew's nodding, which is good. The one other thing that I'd comment on here, because it's been very narrowly focused in terms of what's been driving returns. So there were a couple of really big wins. So Biogen getting its Alzheimer's drug approved. If you were in that stock and you rode up the way from that really helped your performance. If you weren't holding it, you got left behind because it's a big constituent of the biotech index. And similarly, whether you're exposed to these vaccine companies or not made a big difference to returns. So Moderna, BioNTech, I don't know what the other one's called. But they were sort of really jumping around and going up and down. So that's made a big difference. And lastly, I would mention that Syncona here, even though that looks pretty poor, that NAV doesn't reflect the sale of Gyroscope, which we saw a big jump when it sold that in December. So that's going to look a bit better next time we look at it, hopefully when Morningstar gets that together. To you for technology.
Yes, just briefly, Polar Capital Global Healthcare was actually, I think, very close to the top of the list last year, helped by its holdings in the very large cap farmers, which did well. And so technology, I'm always interested in this. I do publish another newsletter actually on technology stocks, and this one, there are not a large number of trusts in the sector, but it's always interesting to see the kind of face-off between Polar Capital Technology and Allianz Technology, which are the two big players. And again, for many years, they were just bracketed together completely. And I always opted out of the choice and just said people should own both of them, which I think is always an option. Actually, Allianz has edged ahead in the last few years. And if you look at the medium-term returns, the 3 and 5 year, they are ahead. Last year, they were pretty much neck and neck again. No great surprise there. I think, if you look at their largest holdings, which I put on the slide, 3 of the top 5 are in common. And I think you can just flip a coin there between those two, or have a look at the ratings and see which one is cheaper. At the moment, it's Polar Capital Technology, but you could always own both. I'll also just mention Augmentum FinTech, which is quite different. And whilst Polar Cap and Allianz are both focused on the US, Augmentum FinTech is UK and Europe FinTech. The UK is not particularly well known for its technology sector, but actually FinTech is really an area where we do have a significant global market position. And I think it's a very interesting trust. It does trade on a premium. So I was going to say you have to, be a little bit cautious, but of course, as James and I have discussed many times, the quoted NAV is not necessarily reflective of the current position. So you can always think about that a bit more deeply and look into the portfolio and see if it makes sense to you. So I think that's technology. Natural resources had a very good year overall. It's a cyclical sector, and obviously economies were coming out of the pandemic depression. There's a very wide dispersion of returns here, though, from Geiger Counter at the top, focused on uranium. Obviously, that's a special situation. You need to look into the economics of that separately. It was the top trust for much of the year, actually. It clipped a little bit, had a little fall off at the end. It's not that liquid, so its rating does move about quite significantly. At the moment, it's on a big 15% premium. If you are trading it, I'd just be quite careful about when you do it, because there's a lot of fluctuation there. Second on the list is Riverstone Energy, which is a really strange situation, quite intriguing, but not for the risk averse, I'd have to say. I mean, that was an old oil and gas investor, widely hated, did very badly, and had a lot of governance issues. I mean, it could well have wound up, but there are vested interests there that basically blocked it because they want the management fees to continue. And so, that doesn't sound like a situation you want to get involved with at all. But actually, they've decided to really switch the mandate, the remit into more modern energy companies, and they're getting into renewables and actually very interesting areas. And they've done very, very well over the last year. And you can buy these shares on a massive discount of about, I think it's 48%. There are underlying issues there, so proceed with caution, but it's an intriguing one. BlackRock World Mining did pretty well in the middle. It's okay anyway, and you get a nice yield on that. The only real laggard of size was Golden Prospect Precious Metals. Obviously, gold actually had a poor year because, in spite of the increased inflation expectations, I think generally people had the feeling that risks were declining, and therefore they didn't need this to hedge.
There we go. Itchy finger. Infrastructure. So now coming on to things that aren't invested in equities, invested in unlisted things. Here, the real winner for many years has been through our infrastructure, and it's really because it's taking a very different risk profile to the other funds. So because it invests in things that are exposed to much more demand risk, so it has the ability to kind of add value that the others don't. So the others are much more of a steady Eddie type investment. 3i has never sort of put a foot round, as far as I can remember. But there's always the risk that it might do. Within the sort of the others, I think the interesting pattern there is that the GCP, which has languished for a few years, had a much better year in 2021. And that's partly driven by the recovery in energy prices, which because it actually, although it's in this sector, which is traditionally much more about the PFI, PPP type structures, it's got quite a lot invested in renewables, and that's kind of skews things a bit. We have got a new entry coming into the end. We're getting quite a lot of issuance in these sort of more alternative investments, and so the Pantheon fund that's going to come in here claims it's going to be a lot more like the 3i one. So we're going to have to wait and see where that works out in practice. INPP, I'm not sure why it ended up at the bottom of the table, but the difference is that we're only doing a couple of percent. So I think it probably merits further investigation by me. And at the bottom end, infrastructure India is something I've been saying for years, which is still well clear of. I think there's a chance it may go bust in 2022. I mean, it's running out of money even as we speak. Environmental was obviously dominating the headlines for much of the year. And Impacts has sort of reaped the reward of that. It is the sort of class act in that sector. And it's investing in the sort of enabling technology for us to decarbonize the world. And therefore, it's likely to carry on being popular for a while yet. The Jupiter Green Fund has never really sort of measured up to its potential. And it did lose its manager earlier on in the year. And that didn't seem to make much difference to returns, unfortunately. Within the two funds that invest in equities, but in the sort of infrastructure space and renewable space, the leader there is the Premier Fund. that's really all down to its split cap structure. So because it's got quite a lot of zeros within the structure, the underlying moving NAV is amplified. And I think if we strip that out, it'd be much closer to the return on Ecofin. Both of those returns, though, are actually quite good. And they had quite good years for 2021. And then the sector that's gone crazy really in 2021 with a lot of new issuance and a lot of secondary issuance as well. I mean, we had sort of Greencoat raising £450 million in December, for instance. It's been renewables infrastructure. There's quite a big dispersion of NAV returns in here too. A lot of it is going to come down to how sensitive your NAVs are to power prices. So as we've seen, there's a lot of talk in the press about it. Gas prices have gone mad in recent months, and that's really a lack of supply from Russia. They've been sort of turning the taps off a bit in an attempt to get us to approve the Nord Stream 2 pipeline. Germany's actually come back and said, no, though, we're not quite sure we want to do that. And that's caused a big spike up in gas prices. And because we use gas to produce power when the wind isn't blowing and the sun isn't shining, so that sets the marginal price of electricity. That's driven up power prices significantly too. So they've been hitting kind of record highs in recent months. So if you had a portfolio where a lot of the power you produced was being sold in the spot market or was on relatively short-term contracts, you'd be ripping the rewards of that. If you had long-term power purchase agreements, then you haven't really benefited so much. Currency has also made a big difference to returns in this sector too. So you can see the European ones sort of lagging at the end there, and the US ones, but all the US ones also have the long-term power purchase agreements. And the one that I would highlight as a big disappointment really is the Triple Point Energy Efficiency Trust, which has been very slow to invest its IPO proceeds. And because of that, it's not been generating income and therefore been paying dividends out of the capital, and that's been running down the NAV.